Welcome back to the audio edition of Tuesday Target. It is week 5 of 52, and the headline this week pulls no punches. Fed faking it, silver breaking it. Yuri, looking at the intro, it feels like the illusion of the free market took a serious hit this weekend.
It didn't just take a hit, Kathy. The mask completely fell off. We watched the New York Fed conduct a rate check to prop up the yen. Let's call this what it is, a soft power Plaza Accord. The Treasury is effectively turning the dollar into a political tool to save a strategic ally. It signals that authorities will manipulate prices the moment the market threatens their version of stability.
So the free market is on pause. But while they are trying to fix the currency, what about that massive markdown at BlackRock you mentioned?
That is the cockroach crawling out from under the floorboards. BlackRock's private credit fund marked down assets by nearly 20%. It exposes the dangerous reality behind those smooth, low-volatility charts everyone loves. It's a mark-to-model fantasy. You have a liquid loans valued by spreadsheets, not buyers. Now that rates are higher, that fantasy is colliding with reality. And as I always say, accounting magic cannot erase insolvency.
And the market's reaction seems to be a flight to safety, but not to bonds.
Absolutely. Look at silver. Look at the parabolic bid for commodities. This is a total rejection of the managed narrative. The crowd is moving capital away from manipulated fiat and opaque credit models toward the only place where true price discovery still exists: physical reality. When the system tries to fake stability, the market breaks the things they cannot print.
Let's pivot to the sector breakdown. You've spotted a massive divergence between software and semiconductors.
It's a classic coiled spring. Hedge funds are holding record-long positions in semis. Everyone loves chips, but they are shorting software stocks to historical extremes. It is too lopsided. A minor earnings beat in software or a stumble in chips could trigger a brutal squeeze. I like betting on the hated sector when the consensus is this crowded.
Speaking of shifts, you mentioned China and the auto sector. Is the war over?
It is. BYD overtaking Tesla in global sales confirms it. The Western tariffs we're seeing, those are just defensive walls. It's an admission of defeat. The global industry is now following Beijing's lead on cost efficiency. Legacy brands are retreating behind protectionism, but the mass market has irrevocably shifted to Asia.
We've got a huge week ahead. Powell, earnings, PPI. What is the tactical play for this tape?
The trade is rotation, not index chasing. Capital is fleeing the crowded mega-cap tech trade for the scarcity of real assets. I like the long Detroit theme, domestic industrials, over the financialized Davos Consensus. Also, volatility is artificially cheap right now because asset managers are shorting it. That makes the market fragile. Buy protection while it's cheap.
Finally, for the options traders listening, what is the Tuesday target idea this week?
We are looking at Salesforce, ticker CRM. While everyone is chasing semiconductors, hedge funds have pushed their short exposure in software to record lows. We are fading the clowns. We're looking to catch a short squeeze here. Check the Elite Trader Discord channel for the specifics.
Long Detroit, short Davos, and some software swinging. I like it. Thanks, Yuri.
Don't guess. Execute. Catch you next week.